Hi, everyone. This is Rob Roy, and welcome to the Yellow Wave Options U.S. Market Update. As we do each and every week, we show you the stocks that will be featured in this recording. And as a quick reminder, you can go directly to a particular stock you may have interest in using the chapters feature in the recording. Another quick note is that we are recording this during market hours due to travel constraints on this Friday. So what I'm showing you could change into the close. So just keep that in mind. We did have some big economic news this week, starting off with Thursday's GDP report, and it came in a little hotter than expected at 2.8%, but that's misleading. If you look behind the scenes, there was a 1 point addition to that from inventories, and when inventories are building, that's actually a negative thing, right? That means that we're manufacturing stuff, but it's sitting on shelves. It's not being purchased, so it does show that a little slowdown in the consumer. So that 2.8 number is not quite that high. I actually wondered if we might see a negative number, but we didn't. So the economy is still okay, but it's not quite that 2.8 headline number. And then today, this morning, we had the Fed's favorite inflation indicator, the PCE report. And in general terms, the regular number came in, the headline number, a tenth lower than expected. Just a 1/10 increase month over month, and we're getting down there on the year over year towards the Fed's target. In addition to that, looking at the core, it was pretty much in line. So kind of decent economic numbers and inflationary numbers for the Fed to move to that September rate cut. We had even put in a little whisper of potentially a cut in July next week when the Fed meets. I don't think that's going to happen. I think that's off the table. I think this is what we saw yesterday in the markets, and we'll look at the chart of the markets here, and you'll see what happened in yesterday's move. And then the fact that maybe we get September. I've been a little bit iffy, as you know, if you've been listening on the September cut, pretty confident in the December cut. But now I think September is highly likely, and I think it's important that the Fed guides towards that. I think the market will be really disappointed next week if the Fed doesn't sound very dovish and lead us to believe that September is going to be a rate cut. So very anticipated Fed meeting next week, and specifically what Chairman Powell says, and that's going to determine what happens next week. So you can see when we look at the chart of the market, ugly day yesterday, little bit of a bounce back today. If I put the moving averages on the chart, you can see that we are kind of holding around the 50-day moving average. So that's okay. So far, so good. Somebody had asked in last week's recording why the level of 550 that I'd mentioned, if we broke that level, things could get ugly. They did for a couple days. And that's because, one, that was the bottom of where the tap box was. But I've also highlighted in the software here the fib retracement. And you can see the fib retracement level of 38.2% is exactly where we bottomed in yesterday's trade. So a little bit of bounce off that fib level. And by the way, we filled this gap here. So although we had a pretty rough week or so here moving to the downside, we are in a level that could hold if we are going to get that melt up scenario. But I think at the beginning of the week, the market is going to be a little bit timid to try to see what Chairman Powell is going to have to say. And again, if he remains hawkish, he's softened a little bit, as you know, but if he remains hawkish, it could get dicey next week. But for now, we're set up okay. We haven't quite made that 1030 bearish cross yet. So far, it looks like maybe just a test of the 50-day moving average, and we have the potential to move higher from here. So you can see the shadowing here. It's a really cool piece of the software. And if you've been under a rock somewhere and you haven't gone to hub.com and gotten a copy of this software, you should do so. It's in beta form. It's free. Nothing to download onto your computer. It's all browser based. And there's really cool features like this fib retracement level. And it shadows to give you the different levels for the Fibonacci levels over here on the right-hand side. So it makes it really easy to see. And just a lot of cool features in the software. So I wanted to show you that. So that's the S&P. Now let's take a look at the VIX. And when we look at the VIX, we had a pretty big move to the upside. I was a little concerned yesterday on this break of 17.5. I thought on Wednesday when we closed above it. 17.5 had been acting as resistance. Perhaps we'd come back down. We didn't yesterday. We'll see where we close today, but at least at this point, the VIX is moving back down. We want to see that get back below 17.5. And oh, by the way, just a reminder that we broke to the upside out of this descending triangle. You've heard me say it a number of times. A descending triangle does not mean a downside breakout. Any triangle can break either direction, regardless of other stuff that you may read. This real world, this is what happens. Triangles break out, but you can't pick a direction. Any triangle can break either direction, as I said. All right, so now let's take a look at rates. We look at the 10-year via the TNX is holding in here pretty well at this 100% extension. Just when it looked like we were going to break down and start to move lower here, we turned and we went right back up, and we're just holding right around this 100% level. And we'll wait and see if the Fed does guide towards the September rate cut, kind of let us know that that's coming, so to speak. Maybe we start to go lower, or maybe we hold right in here. But it is really interesting. And if you wonder why we look at Fibonacci's, why we look at Elliott wave, why we look at zigzags, etc., just look at this chart. Beautiful zigzag right to the 100% extension. We went to the previous fib level that gave us the opportunity to move down if we needed to, or if the market was going to. But look at how this 100% extension is just held here on rates. Now we take a look at the dollar, and we've been talking about this, rates in the dollar in TradeFinder the past couple of weeks. And as a reminder, if you haven't joined us for TradeFinder, you can sign up using the link you see on your screen now. It's free. We do it every Tuesday at 1 p.m. Eastern time, so it's during the market hours. We look at the market, we look for trade ideas, and we have a live Q&A. We have a great community. They ask great questions. Love to have you part of it if you haven't signed up already. So TradeFinder is a great thing, and the conversations these past couple of weeks have been about that chart I just showed you on rates and the dollar. Look how the dollar is pegging right here at 104. There's been a lot of chatter about the dollar yen. That's been where all the action has been, and it seems to be holding here right around the 104, or adding to that. I like that. As you know, I don't want to see the dollar move down too far, but I am a little concerned about this 61.8% wave 4 here, because I don't want to see the dollar take off to the upside either. And I think that's where this Fed meeting next week could play in as well. If Chairman Powell doesn't guide towards that September rate cut that the market wants, it's priced in, it's over 90% on the Fed fund futures, then we could see rates jump up, and we could see the dollar take off, and we could see a further leg down in the markets. But to continue the melt-up scenario, we need the market looking towards that September cut, and then we start talking down the road of that old buy the rumor, sell the news. Once we get to the rate cuts, do we correct a little bit further as well? But so far, bouncing off that fib levels I showed you on the charts, and so far so good. Looking at the DIA, you can see that we came down. We didn't quite make it to the 50-day moving average. We are bouncing back up today. I thought maybe the Dow might come down here to this 50-day moving average, right at the top of that C wave extension that completed in this upward zigzag. We got too vertical. You know the rules. Nothing goes straight up, and what goes straight up and oftentimes comes straight back down. And then we never get too far away from the 10-day moving average. No security in any time frame gets very far from the 10-day moving average. And so we came back down just right to this level. We've held this high here around 400, so where it was resistance seems to be tested. That's normal, as you know. What was resistance then becomes support. So we didn't quite make it down to the 50-day moving average, at least not yet, and seem to be holding that 400 level as support, and maybe the Dow can turn and move back to the upside as well. The Qs, as you probably are aware, got hit pretty hard in that move to the downside that we had earlier in the week. All the way down here, we're at a wave 4 now, right around 61.8%. We're also at those wave 5 highs back from March, broke well below the 50-day moving average here. So notice the difference in the Qs and the Dow. Money moving in, rotation into the Dow, leaving the high-tech stocks And I think we're going to have to wait and see what rates do as far as whether or not we can turn and move back up in this wave 5. We still have this C wave extension in the big zigzag. I took the little one off because we violated that B wave. So that's done. And now we look to see if the big zigzag can hold. This would be a logical place for the Qs to hold, but we've had that bearish cross, that 1030 bearish cross here. So caution remains in the Qs and big tech. And if we don't hold this 450 level, then we're going to see this move down here to around 420, which would be testing this big B wave correction. So it's kind of key that the Qs hold here. So keep an eye on that at the beginning of next week. We are a little separated from the 10-day moving average, so we're a touch oversold right now. So a little bit of a bounce or at least sideways move here seems warranted. But that 450 level is key. We got to keep a close eye on that. All right, now let's take a look at the chart of the IWM. And this one is continuing to blow my mind a little bit here. We had that big breakout from this triangle that we had. I showed you that last week. Vertical breakout. We just covered the rules. Nothing goes straight up forever. What goes straight up oftentimes comes straight back down. We got too far from the 10-day moving average. So pretty high probability that we're going to come back down to the 10-day moving average. But I thought we might actually come down and test 210. You know the levels. We've been talking about that. 210 has been resistance for so long. It was such a strong area of resistance, and that old resistance becomes new support type thing. So I thought we might actually see a movement all the way down to 210, but not so fast. We came down to the 10-day moving average, and that's been it. And we're getting another little bit here in the IWM. So the issue here is, where is the upper end of the new range? We haven't quite made it to 230, and I only use that level because the IWM seems to move in 20-point ranges. So it's just an arbitrary number. There's no real fib levels or zigzag targets or anything along those lines giving me that level, at least not yet. But it just seems like that would be a logical place. So far, 225 is holding, so maybe the range compresses a little bit right through this area here at 225. But yeah, pretty surprising to see that move. There's two sides of this. You know, we've talked about in the past the IWM being a reference of risk on and risk off. A lot of people look at that for risk tolerances in the market, and maybe that's it. Initially, the breakout was with the rates coming down. We broke that 100% extension, as I showed you. So that made sense because small caps tend to do better in a lower rate environment. But then as rates back up, we only corrected the overbought condition, and now we're back up again. So kind of a confusion here in the IWM as far as where we go from here. But so far, holding that 10-day moving average. Pretty interesting there. Let's get into the crypto world. Bitcoin came back down, tested the 50-day moving average, and then right back up, trading back above that 65,000 level. And we'll see if we test 70,000. So the chart of Bitcoin just seems pretty classic here. We had a nice run up, corrected it a bit, tested the 50-day moving average, back above resistance. All that looks pretty constructive on Bitcoin. Not quite the same on Ethereum, though. As you can see with Ethereum, we broke below that 3,500. We were wondering, would we be able to hold here and then make a run at 4,000? But we actually broke down, did not hold the 50-day moving average. Awfully close to a bearish 1030 cross. Didn't quite happen, so a little bit of a snapback up in Ethereum. But I think you have to be cautious on Ethereum until we get back above that 3,500 level. If we can do that, then I do think we make a run at that resistance at 4,000. But as you can see, the selling was a little more severe there in Ethereum than it was in Bitcoin. A little bit surprising to me to see that. Now let's move into the metals. SLV, we were talking about this in both TradeFinder and the Insiders meeting last night, which we do on Thursdays. We do a live show on Monday and a show in the evening on Thursdays for our alert subscribers only at ewotrader.com. Have extended Q&As in those. And this big move to the downside here on silver. We are SLV. We'd come back down. Looked like we were holding for 4 days. We held the point of that triangle. You know those rules too if you've been watching. Triangle breaks out and it comes back down and tests it. That's Elliott wave corrective triangle rules. But then, boom, big move to the downside. So the speculation we've been talking about is that the influence from the tech sector, because you know silver is a big component of technology now. And perhaps that's why that moved down so far. So where does SLV hold? We are oversold right now from the 10-day moving average, and we're trying to move a little sideways here and consolidate. But I do think there might be a little short-term bounce here, but I don't know if we're going to take back off again. I think we're going to have to wait and see what the tech sector does. And then looking at gold, moving into GLD, you can see that it's performed a little bit better. It came down to the 50-day moving average, hasn't made it back down to the point of the triangle yet, so it hasn't satisfied that rule. So I think we have to be a little cautious on GLD. So some caution in the metals right now as we move into next week and that Fed meeting, and they'll probably move based on whatever Chairman Powell says. But I wouldn't be surprised to see GLD at least test this 215 level. Maybe not. Maybe the 50-day moving average holds, but to get that close to the point of the triangle and not break it would be quite interesting. And then moving into oil, look at USO. And we've been talking about this chart and just holding in there really well. Now, OPEC had said that they were going to increase production moving into August. I would be surprised if they do that. I think that was kind of jawboning, maybe just a little bit of pressure from the U.S. on that. And so I think they're just kind of trying to talk the markets down a little bit. We'll see. Seems to me like OPEC would wait and see how the election's going to be, because we got such extremes depending on what party. We don't play politics here. We just talk about how it affects the markets. But on the Democratic side, they're anti-fracking, they're anti-drilling, so not looking for domestic production. If the Republicans win, then that will kick up again. And obviously, that's going to affect the price of oil. So why would OPEC change before the election? So again, I think that was just political theater and just trying to appease the U.S. government when oil prices were running up. So we've held right here at this B wave, and perhaps we consolidate a bit longer here on oil before we see where the next move is. Are we going to get this C wave extension? Finally getting a little relief at the gas pumps, not a whole lot, but a little bit, which is good for the second half of the summer and the summer driving season. All right, as we move into stocks of interest, you all ask about SWKS. And just as a reminder, each month this year, we're giving away one of our free level 3 subscriptions. That incorporates our AI-based impulse strategy, and we've had 5 alerts go out to our alert subscribers just in the first 2 weeks of July that were less than 5 days long. They worked out really well. So that's a directional, the impulse strategy based on AI. Then we have the volatility strategy, which is those triangle breakouts. And then we have an income-based strategy, which is also AI infused. The AI tells us the likelihood of a stock staying in a 1 standard deviation range following a big drop. And we can do counter spreads, butterflies, things that can generate income off of a sideways move. So you have all market conditions covered. It's worth thousands of dollars, and we're giving away one free every month this year. And all you have to do is leave a comment under this video. If you leave a comment, then you're registered for the drawing. So take advantage of that. I read every one of your comments. I answer as many as I can, time and travel permitted. But you ask about Skyworks, and I try to incorporate your suggestions in as much as I can as well. We have a triangle here on Skyworks. So something's getting ready to happen here. We're trading right around the 115 level. When you look, it's about a 110 to 120 mouth of the triangle. So we're going to get about a 10-point move out of Skyworks, but you never know the direction. Remember what we talked about with triangles earlier. So look for some sort of movement out of Skyworks. You also ask about Coinbase, and I usually include that with Bitcoin. Coinbase is where they dumped all that Bitcoin when Bitcoin had its move down. The U.S. government, German government, another one of the crypto exchanges, they all put a whole bunch of Bitcoin. So increased supply went on to Coinbase, and that's why you're seeing Coinbase didn't correct as much as you saw with Bitcoin or especially Ethereum because people are buying them there. They're trading there. So Coinbase is hanging in here, but Coinbase is in a big trading range, and we're at 200 to 275. That's huge. So we really kind of need to see a break of one of those two levels. You would tend to think that it'd be an upside breakout, but let's let it do it. This is just a trading range here. It's not a triangle. So let's let it make its move. I think you just have to watch Coinbase for now. Perhaps there's going to be a movement to the upside on Coinbase as it breaks resistance. But for now, it's just in a big trading range, and let's let it play itself out. Intel, you ask about. We haven't looked at Intel in a while. And we have, this is not really a well-formed Elliott wave pattern because this sideways stuff here, we had this little triangle. That's what we were looking at last time we looked at Intel. We had this little skinny triangle, and it made a nice breakout. So there's the breakout of the triangle. Again, that's the stuff we do in the volatility portfolio. So there's the big breakout. And as following rules, you've heard me say it already a couple times in this recording, right back to the point of the breakout. So Intel is following Elliott wave corrective triangle rules to a T. Now we have to wait and see what happens. We're getting awfully close to a bearish 1030 cross, but there is a ton of support right here around 30. I would be surprised if Intel breaks that level. You could almost look to take a speculative trade on some sort of a bounce off of 30 if we get back down there again. The point of the triangle may be as far as we go. So looks interesting, but understand when we get these kind of oversold bounces or bounces off support, they're short-lived. So doesn't mean that we're off and running to the upside, but I do think this five-wave pattern has a likelihood of being disqualified. So again, I don't pay too much attention to that unless we break below 30. Now, if we break below 30 on Intel, then yeah, we are looking for a wave 5 low. But as you can see, it's still labeled green, so the algorithm has not found confidence that that's the end of the bounce up. So coming back down here, we could bounce a little higher if things start to get a little bit better in tech land. SMCI, wanted to show you that because we talked about how if we could hold this area right in this 790 area here, then the whisper of potentially a stock split in the future could hold it in there. But if we break this level, then we're looking at the wave 5. Well, I wanted to update you on this and show you we did indeed break below there. And no, we came right down into the tap box where the wave 5 is. We're getting a little bounce today, but that's just because we got too far from the 10-day moving average. So I think you have to be kind of cautious on SMCI now. If you want to be long this, you got to wait till it's back above 800, I would believe. Here's the scary part, as you can see how vertical this run was back here from 400 up to 800. There's nothing here to hold it on the way down. So there's risk all the way down here. It doesn't mean it has to do that. Just saying that it's kind of in no man's land. I use the analogy of, hanging on the edge of a cliff by your fingernails. That's what's going on with SMCI right now. So please exercise caution there. And then UNG, wanted to show you that one too, because we talked about this 15 level. It broke below it. It came back up and tested it. It needed to get above it. It didn't. And now we're just kind of trickling down. And it looks like Led Zeppelin. The song remains the same here on UNG. How far down can we go? We're in a wave 3. We've broken below 15 that needed to hold. We're just going to have to wait and see where it catches itself. So a slight bearish tent to UNG. Needed that 15 level to hold, and it didn't. Finishing off with the INDA, as we always do, you can see that we came down here. I thought we might come down and hit the 50-day moving average. We didn't quite do that. We bounced back up, and you can see a nice move back to the upside today. So just a little bit of a correction. We got a little bit of moving back together here between the 10 and the 50-day moving average. That works the same as any security on the 10-day moving average. The 10 and the 50-day moving averages don't separate a whole lot for very long either. So same kind of guidelines there. So you can see the 10-day moving average came back down towards the 50s. So we condensed that a little bit. And now we're trying to make another run. So now we're looking at the INDA. Are we going to break this wave 5 high? And if we do, does that 5 relabel to a 3? Or do we make one of those rare 261.8% extensions in the INDA? But just a nice little normal type correction here, held above the 50-day moving average, which again surprised me a little bit, but back to the upside. So we'll see how the INDA plays out next week. But fasten your seatbelts next week. I think the market, again, will be a little cautious moving into that Fed meeting. It's going to be really important what Chairman Powell has to say, and I'll be back to tell you what he said and how the market reacted. Have a great weekend. Appreciate your time. Look forward to talking again soon. Take care, everybody.
If you like these recordings, I'd like to invite you to join our new TradeFinder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.